Good afternoon. Happy Friday. This is Sean LaBelle of the Decker Hewitt Group. North American markets were poised to break out of a 2-week slump here on Friday, but we had a little bit of weakness in the last couple hours of trading. North American major benchmarks gave back most of this week's gains. We view these temporary breaks in the market as opportunities to be bought, while obviously painful in the short term. With a long-term time horizon, investors have been consistently rewarded for buying these sort of dips. This week's Market Watch Weekly dives into the 3 stages of an economic recovery, normally that being a sharp, immediate sell-off followed by a quick rebound, and then third is sort of the gradual recovery to pre-recessionary levels. Within that third stage, you do get periods of consolidation. We view ourselves to be in the third stage of this economic recovery. It's important to remember that consumer confidence is rising, monetary stimulus is at record levels, and we have a gradual recovery of global economic indicators as evidenced by this week's OECD numbers. It's important to remember that obviously the pandemic is in the driver's seat right now, but it is the US Fed and other global central banks paving the road ahead. This point was actually reiterated this week on Wednesday. We had US Fed Chair Jerome Powell basically say that interest rates will be at zero until we get inflation sustainably above 2%. That means that investors should expect zero interest rates to at least 2023. What this means for investors is that historically, economic recoveries are actually choked off by Federal Reserves raising interest rates too quickly. That's obviously not going to be the case in this economic cycle, which is why we are bullish for a long-term time horizon. We've got at least 3 years of zero interest rate policy, which is a huge tailwind to global equity benchmarks. So that'll do it for this week's Market Watch Weekly. Hope everyone enjoys their weekend, and we'll talk to you next week. Cheers.